We're talking AI, we're talking balance, we're talking parenting later. I do want to shout out the only person I talked to during this roundtable was Matt Miller. Matt Miller, my arch enemy. We went to rival high schools in Chicago. His team with Chicago Kicks beat my niece's team on Saturday in a Liberty tournament, so you and I are not friends. We are rivals here. We're going to get to more. There's lots of people around the room. Talking to Craig Robinson later, who has some very interesting takes on the parenting, the level of parenting, and how that all mixes into the equation. But hopefully you guys learned something. We're going to delve deeper into AI, which we are, of course, excited about, a hot topic in youth sports. Also, though, is private equity, something that I know very little about. And so that's where the questions and the curiosity and whatever questions you guys have to connect and ask as well. You know, the questions like, should I sell my business? Should I not? Where do I even start? So we are excited to welcome Rob Pietroforte, the co-founder at Fortified Partners, and Gordon MacNeil, of course, and we welcome back CEO Brian Litvack back to the stage, and we were going to talk to all of them to sort of put together the puzzle of private equity and how it all gets sorted. So give a nice round of applause for these gentlemen. Thanks, guys. Welcome, welcome.
I'm excited to be up here with you guys who go to the gym a lot more than I do. So both are good friends and excited to be on this panel. And when we started Next Up, we did not think we would be, in 2019, we did not think we would be having panels about youth sports and private equity. But here we are, and I look forward to breaking it down some with all of you in this session. So I'll quickly introduce Rob and Gordon, and then hopefully get into some questions and then leave some time for Q&A. Rob is the founder and CEO of Fortified Partners, a sports-focused merchant bank here in New York. He leads the firm's advisory and principal investing businesses with a focus on sports, really, professional sports, youth sports, sports technology. Rob is doing both youth sports and sports betting, so we could talk to him about that. Before Fortified, Rob was head of M&A and strategy at Genius Sports. And prior to Genius Sports, Rob was vice president at the Rain Group, where he helped lead the firm's sports efforts. And before Rain, Rob worked in sports and entertainment group as a banker at J.P. Morgan Chase, where he worked with Madison Square Garden, the U.S. Open, and other sports properties. Rob is a Johns Hopkins guy, where he was a baseball player, not lacrosse, and an MBA from Wharton, where he was a Palmer Scholar. Rob was also instrumental in working with League Apps over the last few years to get us into the position we are now on kind of corporate development and M&A, and is a friend of mine, and to my son, who's now in the front row, is known as V-Bucks Rob. And then Gordon is a partner at Accel KKR, one of the leading PE firms investing in growth stage software, including League Apps. Gordon has over 15 years experience in PE and investing banking across different stages and sectors, mostly software though, right, Gordon? Prior to joining Accel KKR, Gordon was vice president with Genstar Capital, and before that was at Summit Partners. He started his career in technology investment banking at Oppenheimer. Gordon has an MBA from Harvard and a BS from Penn State. They started the year 3-0, so we'll see how it turns out.
And that was below the line. That was not necessary. Come on.
And what is very neat is both Gordon and Rob are college athletes and super passionate about this space, and probably could talk not just about private equity, but about how sports and youth sports has impacted their life and their professional career and their relationships and their networks. I want to start with the simple question of, the word private equity has been thrown around in youth sports circles more than ever before. It is something that I'm talking to many of you about. Gordon, can you explain what private equity actually is?
Yeah, absolutely. And thank you all for the time today. It's a pleasure to connect with you all, and very much appreciate your support with League Apps. So private equity, very simply put, is ownership within companies outside of the public universe. And so to dig a little deeper on that, what happens is you have a group of folks that will come together to raise a bunch of capital. So they'll go out to university endowments, healthcare institutions that have capital, pension plans. They'll raise a bunch of capital and they'll put it into a fund. And then that group that raised that fund will then go invest those dollars on behalf of those what are called limited partners, the people that put that initial capital in. So they go invest those dollars, work with those private companies to help build them, to help make them better, to help make them more profitable. And then at some point in time, there will be a transformative event where that company will sell, or it'll move on to a strategic, or it'll go public, or something like that. And then that capital is then distributed to those original limited partners. And then what happens is if you're good at doing it, you do it again and again and again. And so you'll hear some firms have raised their 6th fund, some firms are on their 1st fund. But that's the process by which people are acting to make those investments, and that is what private equity is.
Thank you, Gordon. And we'll come back to private equity in a second. But Rob, I asked you earlier, and you said you've had about 100 conversations about youth sports investments, and that kind of blew my mind. So what are these conversations that you're having? Why is all this capital coming into youth sports? Not just private equity, but who are the different types of investors that are showing up? And as you're speaking to them, and speaking to both youth sports organizations and the investors, what are you hearing?
So I think in a lot of ways, the League Apps deal last year started a domino effect, where I think a lot of institutional capital and a lot of operators like those in this room, looked up and said, okay, this is becoming a place and an industry that a lot of people are starting to invest in. And I think that's happened for a number of different reasons. I think the first is people look at the youth sports industry and think it's a big market. I think today it's a $40 billion market that's growing to $70 billion in 2030. So a huge market opportunity. It's totally fragmented. I think the top operators in each sport have less than 1% of the market share. You've got a lot of money coming in, so there are more buyers like Gordon, like strategics, like other firms that are coming into the market. And so we're seeing a lot of people that had invested in home services business roll-ups or veterinary clinics or other parts of the sports ecosystem taking note and starting to figure out what assets they want to invest in the youth sports space. We probably have spoken to 100 different people in the youth sports industry over the last year. That's investors, it's operators, it's people trying to figure out what do I do and what do I make of these conversations. Some people are looking to raise a small amount of money to grow their business. Some people are looking to sell. Others don't really want to do anything and just grow the business and figure out what's going on in the broader ecosystem. And so we try to help them make sense of some of that stuff.
For many years, I used to like to say no one got into youth sports because they wanted to make the most amount of money. And now there are people who are coming into youth sports that feel like it is a way to generate revenue and profit. Rob, we had a poll earlier this morning, and it was, what percentage of the organizations in this room have had conversations around capital or merging or buying or selling, a financial discussion? Seemed like it was 70 or 80%. When a sports operator or someone in this room does get approached by someone that has some kind of centralized or committed capital, what should they do? How should they approach the conversation? What questions should they ask? What should they make of that?
So I think the first is it's always flattering to have inbound interest, right? It's credentializing it. It's validation that you're doing something interesting and that other people are taking notice. What we always tell operators is you want to be prepared, right? Like there's going to be inbound interest. There's a lot of money in the space, but being prepared and doing the work so that you're ready to have those conversations is critically important, right? And that, to me, that means having financials that are buttoned up, going through your QuickBooks, working with an accountant, getting a real read on what that financial view is, and having that validated by a third party is important. I think getting your data, from a company like League Apps and understanding what your KPIs are and packaging that together so that, the potential investors or buyers can get a clean read on what it is that you're doing and how that's grown over time is important. The other thing I say is hire a lawyer, right? And I know that's it can be a bad word from time to time. It can be expensive, but understanding what's in your operating agreement and your legal docs, right? We've seen a number of franchises that they own 100% of one entity, they own 60% of another, and it's unclear what happens if they were to do a sale or a change of control deal. So the number one thing we say is be prepared. I think the second thing is understand what it is that you want as an operator, right? There are some people that, again, want to continue running their business. There are some that look at all the activity in the space and say, wouldn't it be great if I had a partner like Excel KKR to help me grow the business and help me with M&A and help me build the platform? And there are others that are ready to go. And they've said, I've been doing this for 25 years and I'm just ready to sell 100%. So I think it's one, being prepared, and then two, being honest with yourself about what it is that you want to do, make those conversations a lot easier.
Thanks, Rob. Gordon, we joked when we started talking, as much as you care about youth sports, you like the fact that we were a software company that was vertical SaaS and payments, and that was very much the types of businesses that you were looking to partner with. And as I said, you do mostly software investing. But as understanding PE, why is PE so attracted right now to youth sports operators?
Yeah, and this is not a plug. So as Brian said, I don't invest in services companies at all, or youth sports actual operating companies. But I think the same tailwinds that exist for both software in youth sports as they do for the actual operators, and that is, you look at some of the, starting at the top, from a macro perspective, there's more capital that's being put in towards the category, and that's because there's more parents that are spending money. The expectations are higher than they ever have been. Female empowerment, youth participation, the importance of youth activity, all of those are major tailwinds that drive growth and that make it an attractive macro environment. If you think about it, looking at the businesses from a fundamental perspective, there's recurring revenue. Investors love recurring revenue because it provides visibility, it provides consistency, and you're able to understand where that company is going to be in 5 years, and you're taking less risk than you would have to for a company that has massive fluctuations in revenue. They're typically profitable. The dollars that people are spending, yes, there's costs associated with these businesses, but there's dollars that drop to the bottom line. And at the end of the day, what do investors care about? They care about revenue, they care about growth, and they care about profitability. And so if the industry has a strong tailwind, if there is a profitable, high-margin business that you're operating, investors are going to be attracted to that category.
I want to now next go into, I think, two questions on everyone's mind. How do you value a youth sports business, and how should a youth sports operator think about the value of their business? And then if they are looking to do some type of partnership, what matters, right? From control to different terms to what happens after. So, Rob, very generally, what are the rules of thumb for how sports operators should think about how their business might be valued? Most sports operating businesses, especially if you don't own your own facility, are, sub $3 or $4 or $5 million. There's a lot of people in this room who've done a phenomenal job operating to get past that. But how should they think about what their business is worth now that they're, whether they want to or not, are being faced with these discussions?
Yeah, so I think, look, broadly, it's company specific, right? What's your profitability? What does your growth rate look like? What part of the industry are you in? All of that matters, right? But there is, what we've seen in the data is that there is a direct correlation with the size of your business and the multiple that buyers or investors are willing to pay for that business, right? So what we generally tell people is, if you're a smaller operator, right? If you're doing $250K to $1.5 million in EBITDA, private equity investors have generally valued those businesses at 5 to 7 times EBITDA. If you are a larger operator, if you're doing $1.5 million to about $5 million in EBITDA, companies, firms are valuing those businesses at 8 to 10 times EBITDA. If you're larger, if you're sort of on the cusp of like almost becoming a platform, if you're 5 to 10 million in EBITDA, we've seen 10 to 12 times. And then for the larger platforms, the Unrivaleds, the Perfect Games, the guys that are doing north of 10, they're 12, the multiples are like 12 plus on that. And so that's generally the way we think about valuation.
So let's get really practical here, Rob. One, we see a lot of organizations that are doing really well in their market get to a few $1 million, let's say $2 or $3 million in revenue. And sometimes EBITDA is even hard to figure out depending on how they're doing their accounting. But let's say their margins, and I talk a lot about this, are 20%, right? 15, 20%. So they're this $3 million business. They're, $500,000 a year or so. How should they think about what their not what is it worth, like what is that decision? Is it like I could keep on running this business, and if I do the same thing, it's for instead of having to do this for 5 years to get that, I could get that up front and then still be involved in it in some way, and I get some security or I get some upfront cash flow and take risk off? Is that how? And then it's like how many years of work can they almost like pull up if they would do a partnership or a deal?
So the first thing is do your accounting, right? Because we've seen so many deals that, you think EBITDA is one thing, you do the quality earnings report, the accountants come in, and EBITDA is 20, 25% lower, and the whole deal gets retraded, right? And you've just wasted 6 months of your time and legal expenses, and there are just too many, cautionary tales of that where, like, if you take anything away from this, it's like, do the accounting, make sure EBITDA and revenue are what you think they are. In terms of the company that, you just mentioned, right? If you're doing $500K in EBITDA, $1 million in EBITDA, my view is like where we are today, a lot of the private equity firms, are looking for their platform asset. They're looking for...
Explain that. Explain what that means.
So they're looking for something of scale, a business that does, $5, $10 million plus in EBITDA, where they're willing to pay a premium multiple, a 12 plus multiple. And their thought is, if we go buy up smaller operators and we streamline, back office, and we help with revenue generation, we help with marketing, and we use best practices, we can bring that multiple down over time by buying less expensive companies. If you are a smaller company, right, if you're doing a $500,000 to $1 million in EBITDA, then you run into the question of, okay, do I want to keep doing this alone? Do I want to raise money from a private equity investor that will buy, not control of the business, but will help me with, a $2-3 million check and enable me to grow faster? Or do I want to sell control to either a private equity firm or a strategic buyer? You asked the question, how is that structured? And honestly, that's case by case, right? I think in most of these acquisitions of smaller companies, strategics want to buy control of those companies because they can consolidate all their financials. They have control and they're able to roll out the value creation playbook and help with best practices and help with marketing and all the stuff that we discussed before. But what that deal looks like is really case by case. You could sell 70% of the business and take cash off the table and roll 30%. You can take 100% in cash off the table and roll nothing. Again, a lot of that depends on who the buyer is and what the seller wants to do.
Gordon, we talk. You spend a lot of your time meeting with founders of businesses in your sector, but most youth sports operators, I say this to my team all the time, I think this is true for people in this room, have some combination of passion for what they do, philanthropy, that it is bigger than just themselves, influence and community, and that they care that they matter within the communities and the families that they work with, and then organizational, operational know-how and grit, because it's hard to actually make sports happen. And they didn't get into it to get to some EBITDA number to do a transaction, right? What should they be thinking about when they're talking to investors around not just the valuation, but all of the other things that matter in bringing on a partner?
Yeah, I think there's a ton of variables to consider when you're thinking about going through a transaction. What Rob just mentioned is spot on, and I should have mentioned it when I talk about the attractiveness of this industry, is there's extreme fragmentation. There's thousands of leagues that are out there across the United States in each one of these sports, and private equity loves to create scale. And so starting with a platform and then going and doing add-ons and transformative acquisitions, that can create scale quickly, and there's multiples associated with that. The bigger you are, the more valuable you are, the higher multiple you get, even for the same dollar of revenue or EBITDA. And so as you're evaluating a potential offer, who your partner will be, I would really, really encourage you to think long and hard about that, because not every private equity firm is the same. Some of the things that you should be thinking about are, where does the capital come from? So is the capital coming from some sovereign wealth fund in the middle of nowhere that maybe you don't agree with the ideals of that government? Are they coming from endowments? Are they coming from healthcare research institutions. Like, where is that capital coming from? Because at the end of the day, when we're building something and we have an event down the road that generates a return, where does that return go? Who's it going to? Just as important is, what are the values of that organization? Who's the partner and the deal team that's going to be leading that investment? Do you align with that individual? If you're planning on staying with the business and driving it forward, you don't want to be in a situation where you're conflicted with your investor and a decision has to be made and both of you are at ends with each other. You also want to think about what the strategy is. So am I the tuck-in? Am I the platform? Are they going to go buy a whole bunch of things together? Are they going after different sports? Are they going after the facility? What is the strategy that we have together, and do I believe in this strategy? And then, look, it's really important. I mentioned not all firms are the same. Not all firms have the same resources. So some firms will come and they'll be value-add investors where they have an operating team. They have a group that will work with you. They'll have a group that'll get their hands dirty. They'll have an M&A team that they can leverage and that you can leverage to expand quickly. Those are valuable resources. And some investors, and maybe this is what you want, but some investors will invest and then they'll call you up 2 years later and they'll say, how's it going? And maybe that's what you want. You want passive capital. But all of these things, I think, are considerations that you should really think through when you're talking to private equity firms or investors and making that decision.
The only thing I would add is, like, doing a private equity deal, taking investment is like a marriage, right? And the firm matters, and the values matter, and the strategy matters, but the people also really matter, right? Because you're going to be spending a lot of time with them. You know, it's probably 5 to 7 years in most cases. And I'll tell you, like, when we were considering our deal with League Apps, there were a number of people that were really, really interested. And look, part of the reason we did the deal with Excel KKR, and this is meant to be a plug, is Gordon was great, Dean was great, the whole team Excel KKR, they'd played college sports, they understood the market, they were values aligned, they were vision aligned, and that really matters, right? Because you don't want to do the wrong deal for the wrong reason with the wrong people. And so it's really important. I tell people, date a bit, right? Talk to a bunch of different investors. Get a sense of who they are, what makes them tick, what they're interested in, because that'll help shape your perspective on what you're looking for in a partner as well.
Yeah, and just to add to that, when League Apps went to do a new partnership last year, we had, and often in software it's different than your businesses, we invest a lot. We had 60 investors over 15 years. They weren't really appropriate for the stage of the business, so we wanted to find the right investor who could be our partner. And me and Jeremy and the management team of League Apps wanted to keep on doing this. So those were some of the stipulations that we had, that we would find someone that was aligned with our mission and what we wanted to do and what we saw the opportunity was for us to have more impact, and ultimately partnered with AKKR and really excited for the opportunities ahead of us and the way we're working together now. I want to open it up to questions. There's a young boy in the front, Graham Litvak, who's going to get the microphone and give it to the people who are asking the questions. And this is how he's going to earn his Robux for later tonight. But when should you not take investment? When, a lot of these businesses, 100% equity is owned by the founder. They started this. They have beautiful businesses, but now they're getting these conversations. And again, it's flattering for the first time. But when should it be like, this is, and I think sometimes it's like, well, now I'm going to have to compete with the guy down the street who took investment. So how should you think about it? Maybe I'll ask you, Rob, when it isn't, advantageous to take investment.
Look, I'll come back to the point I made earlier, which is, like, you got to be prepared, right? There's going to be inbound interest. There are going to be people knocking down your doors, sending you term sheets, trying to get you to sign on the dotted line, right? The best thing that you can do is take a step back and say, okay, let me get my house in order. Let me understand the financials. Let me do the quality of earnings. Let me get a read from a lawyer, and be prepared to engage in those conversations. Because you, as the operator, I guarantee you, if there are multiple people chasing you, the best thing you can do is be prepared for those conversations and not take the first offer that comes your way, right? I think, look, if you believe that you are best in class and you don't need the help and you don't need the capital, don't take the capital, right? But it's really a personal decision, and only you will know if it's the right time to sell a piece or the whole thing or to do nothing at all.
Questions?
These are the appropriate size.
Go on, buddy. I know exactly. Thank you. Hi. I'm Sky with Soccer Parenting. I'm in the middle of my first raise, so it's been quite a process. I'm looking to capitalize my company with just probably $2 million of convertible debt. I'm having a hard time reaching people because my earnings aren't to a point where people are interested. And I just kind of was curious, any advice that you might have in this situation, because I know, sports is such a heavy space that investors are looking in, but for those of us that are a little bit smaller and are just looking for like a pre-seed round.
Look, I think what we see at that phase, a lot of it is friends and family. A lot of it is relationships. A lot of it is, look, the League Apps guys do this as well as anybody. Early days, passing the hat around to 60 plus people, right? And so like early stage, it is the hardest raise, right? That first raise, the pre-seed raise where you're not generating cash is the hardest one. So a lot of it is, yeah, okay. Again, that's sort of like the first thing I would say. The other thing I would say is there are probably strategics in your market or people in your market that have gone through something similar. I'm just sort of thinking about Love Volleyball and a number of volleyball operators that we've spoken to, and does it make sense to talk to them about, some, debt financing or something where they don't have control of the business, but it gives you the capital you need to scale and to grow and to continue to, build the ecosystem, right? So those are probably the two things that I would think about early on.
Yeah, and there's a lot of our partners here in this room today who have either recently completed transactions. Some of them were announced. Chris and Jake and Mike from Chew Sports are here. Jordan from Empire Baseball was just announced last week. So good resources to have in this room to understand the process that they went through, and I'm sure we'll be very open with you about explaining the process and situation that they experienced. Other questions? If it's far away, my son has to run further and gets more V-Bucks. And just stand up if you can and share what your name and what organization you're with.
Make sure he gives you a bunch of Robux for that, okay? All right, my name is Kazim Walji. I'm from Kids in the Game here in New York City. And just had a quick question. We're seeing more private equity investment in youth sports, which is great, which could lead to also some consolidation into a handful of larger organizations. From your perspective, how might this trend impact the accessibility, affordability, and of community-driven nature of youth sports? And what responsibility do private equity-backed companies have to balance both their growth and their returns from the development of community values that make youth sports so impactful?
Sure. Gordon, I'll let you answer from a private equity perspective, and then I want to chime in as well.
Yeah. There absolutely is more investment dollars going into youth sports, and we talked about it earlier. But the hope is that by doing more investment into the category, you make it more accessible, right? What you're doing when you're investing and aggregating a lot of these companies together is you're creating more resources, so more ability to invest in the programs, more ability to invest in the facilities, more ability to invest in the technologies that help facilitate all of that play. That's the intention. That's what you're trying to do. As far as the obligation, like we think about that all the time. I think about that, and one of the reasons when I said consider who your investor is, consider where their capital's coming from, is because when we're doing our job, what we're doing is we're generating returns for what I think are some of the most altruistic causes there are. And whether that's the Howard Hughes Medical Research Institute, that could be my mother was a nurse for 35 years and Hoop is our largest investor. That's her pension plan. So we're trying to drive returns for, I think, a broader cause. And the accessibility, long-term, like what we're trying to do is create long-term value in these businesses. And so long-term, I think we're all served, the company's best served, and the value's best created by creating more accessibility for everyone.
Yeah, and I would say for League Apps, because we went through this, we still have the mission that is as strong as ever. We thought with the right investment partner, we would be able to do more and have more impact, and would be able to be on stage and say we're investing in AI, and we're going to acquire tools that we think will be able to unlock more value when they're with us, and we can further drive the things that we want to do whether it's the service and the product that we provide to our partners, whether it's the way we back fund play, whether it's the how we believe we have a position in the industry. And I remember, to what Gordon said, someone else said to us, you have a moral obligation here to do right if you take investment and find the right partner and continue, if you believe you're leaders in this space, to help create accessibility and to help do all those things. So I think it is upon the leaders and the operators in this space to ensure that if capital is coming in, it's going towards the right reasons. It's going towards creating efficiency and making things better and creating better experience and having it so that kids win. And I know that Jordan from Empire Baseball or the guys I mentioned from True all believe that as well. So, the point of this panel is to say this is happening. How should you handle this situation? How should you look at it? What is the framework or perspectives that you should take? Because it is a trend that we see pretty aggressively kind of working through the market. And these are all the right questions to ask around what is the impacts, not just on those that raise kind of capital, but on everyone in youth sports. I think we got time for one final question, or we'll just make my kid run around a bunch. Five, four, three, two, one.
Ryan Kaplan on the Radar Sports. One of the questions I have is when you're doing roll-ups, I think one of the most difficult things can be retention of, whether it's the cult of personality, especially in youth sports. A lot of the parents, the players are following coaches, instructors, and leaders of organizations that have been around sometimes for decades. If they're taking sizable equity off the table, what's your strategy or your thought process around retaining those key individuals and also keeping them motivated to kind of stick around to maximize the investment?
One thing I'll say is I think the most important role in this next version is those operators that do a phenomenal job making sports happen in their community. They will be the most valuable because, as you just mentioned, without them, the whole thing dissipates pretty quickly. And they have such passion, philanthropy, influence, and kind of grit to make sports happen. So I guess then, tying it back to you guys, like what is that there is such kind of key man element of youth sports operators? How is that accounted for?
So I don't want to be overly simplistic, but it's about incentives, right? You want to make sure those key people are incentivized to grow the business, and if the business has another second bite of the apple, they win just as much as everybody else, right? So whether that's rolling some of their equity, whether it's topping up their equity and giving them more shares in the company, whether it's long-term employment contracts where they feel like they've got a great base and a great bonus that makes them excited to go to work every day and pays all of their living expenses. But that's what it's about, right? Is identifying those key people, making sure the incentives are aligned, and making sure they win as everybody wins as well.
I think it's a fantastic question, and I couldn't agree with Rob more. We often think about the carrot or the stick, and we prefer the carrot, right? And a perfect example, whether you're an operator or a software company, is we wouldn't have invested in League Apps unless Brian and Jeremy were effectively still invested in the business, right? We want them to continue to drive their vision, to continue to support their mission. And when we made this investment, we had to go through that exact same process. And thankfully, Brian and Jeremy are still extremely invested in the company, and we want to continue to provide them with the opportunity to build this business, to support you all, and have the economic opportunity that we have as investors. And so for us, it really is aligning incentives, whether it's through management incentive plans, rollover and equity, investment dollars, all of those things create all of us being in the same boat, rowing together.
I want to thank both Rob and Gordon for being part of the panel today, being great partners to me and to League Apps. Rob is doing office hours and is open to conversations around this. So please use him, use each other to learn more in these areas and understand your options and understand what's happening in the market, whether it's to you or to other organizations, or if you're a nonprofit organization and you're trying to understand what's going on here. I think we can all become more educated and more understanding of some of the kind of trends and complexities that are happening in the youth sports market. And interestingly enough, our next speaker, or one of our next speakers, is a really talented operator who had raised money in previous businesses and hasn't done that yet in his business today. So we'll see all different kinds of perspectives throughout the day and throughout the next few days. And then a shout out from my panel tomorrow. I'm talking about kind of financial well-being of organizations and how you should think about accounting and kind of the best business practices and structures to put your organization in the best position to not just make decisions or not just look at capital, but also how to make the best decisions. So I think these are all parts of what we were speaking about earlier today, which is how do you elevate your organization? How do you put your organization in position where it can help you achieve your goals and kind of help drive forward the mission that you have for youth sports in your communities. So thank you guys. It was awesome to be up here with you.
Thank you.
Thank you all. Appreciate the opportunity.
Woohoo! Thank you, Rob and